following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on either 94.1 FM WNBU or cable TV 10 in New Bern. Some of you may be listening on the internet from our website, www.dlblain.com. It's a great source of information. We put all our radio and TV shows up there and love to hear from our viewers and listeners. If you have any comments or questions on the show, feel free to get in touch with us. If you're on the website there's a big Contact Us button. Just hit that. Or you can also send us an email. The email for the show is allthingsmoney@dlblain.com. And the phone number is 252-633-0107. And like we say, love to hear from you, our viewers and listeners, topics that are on your mind, questions that you may have. We love to cover them on the air. Just was a guest on the Phil Knight show here in New Bern today. Had a great show with Phil. If you aren't familiar with Phil, his show runs from 7 to 9 o'clock. Weekdays on cable TV 10 and 94.1, the same channels that we're on, and he's got a great show there. Talks about some politics and local happenings as well as national things, and really, as Phil was saying, got him juiced up over the fiscal cliff, and we were talking about the fiscal cliff. So I thought I'd continue on that discussion. If you missed me on the Phil Knight show, we'll talk about that a little bit here today. Also talk about bear markets. It's been a while since the last bear market ended back in March of 2009, and this is kind of the typical cycle that happens. People forget about the history and they forget that bear markets occur. I know a lot of people haven't between 2000 and 2009, but we want to talk about bear markets and investing and why, to coin a phrase from Larry Swedroe, why they're a necessary evil. But before we do, talk a little bit about the fiscal cliff here. In case you haven't been paying attention at all, the fiscal cliff is a series of tax increases as well as spending cuts that will occur December 31st if Congress does not take any action. And they have far-ranging effects both in the spending as well as the taxation regime. And on the one side, you have the Democrats that are basically opposed to any sort of spending cuts and want to raise tax on the higher income taxpayers. The Republicans on the other side would like to see some spending cuts and in return for either reducing the deductions on higher income taxpayers or raising the marginal rates, which they just announced that they might be willing to do. So we have this impasse that is the result of the 2001 when they were trying to raise the debt ceiling. A compromise to agree to raise the debt ceiling is that they passed this law that said if Congress takes no action, all these new taxes will go up and all these spending cuts will take place. And so that's where we are today, is it was just kicked down the road, and so we're sitting here. And what I did some analysis on the individual households and kind of boiling it down to the impact that it has on individual families. And so what we see is that some of the most nefarious impacts of this are not the millionaires and billionaires that the press and the president seem to be honing in on, but it's the average Americans out there that are going to bear the brunt of this. One of the things, what they call the payroll tax holiday, that was enacted first under President George Bush and continued under President Obama, that reduced the Social Security portion of an employee's tax from 6.2% down to 4.2%. So that 2 percentage point decrease in the Social Security tax, their take-home pay went up by that amount. Well, that's scheduled to go away since the Social Security has a maximum wage base of $100,000, you can see that the lower income taxpayers are hit more disproportionately by this tax than our higher income taxpayers. So that's coming. Number two is the expiration of the tax rates that were enacted under President George Bush, which implemented what's called the 10% tax bracket. Previously, the lowest tax bracket was 15% for many, many years. Under President George Bush, he enacted a lower starting tax bracket of 10%. So that means that the first income that people earn was only taxed at 10%, and then the next bracket was 15, and then on up 25, 28, and so on into the 30s. Under the rules that are currently in effect, if Congress does not act, that 10% tax bracket goes away, and the lowest earning income or the lowest tax bracket will now be 15%. So that's in effect a 50% tax increase for the lowest paid Americans. And we looked at single people making, $20,000, $25,000, retirees making, $30,000 to $40,000, and the combination of the expiration of that 10% tax bracket, the payroll cuts, well, not for the retirees, but for the younger working families, as well as the dividend increases. The tax on dividends has been at the preferential capital gains rate. For years prior to President Bush enacting that, dividends were taxed at ordinary income rate, and so that hits your retirees much more hard. A lot of them invest for dividend income and rely on their savings and investments for at least a portion of their income. And certainly, the clients we deal with, it's a very important part of their income, in addition to Social Security, pensions, things like that. Income from their portfolio is an important part. So we see those two key demographics, the working class folks that are making, in the $20,000, $30,000 range, and then your retirees making in the $30,000, $40,000, $50,000 range, their taxes are going to potentially go up by 50%. As we get into the higher earning professionals, maybe you have a husband, that may be a doctor, or the wife is an attorney or something, and they have, a couple, 2, 3 children, and they make, $120,000, $150,000 a year. Their taxes are slated to go up significantly as well. Of course, the payroll tax holiday, the marginal tax rates, but with them, the alternative minimum tax starts to kick in. And the alternative minimum tax was a tax regime that was set up initially to ensnare, a dozen individual taxpayers or something. Well, over the years, due to Congress's inability to fix the alternative minimum tax, it slowly ensnared more and more lower earning taxpayers to where today it's a big factor that affects moderately earning taxpayers, especially in your higher income tax states. Here in North Carolina, it has some effect. We've got 6 to 8% tax, but the larger, higher tax states, it really has a big effect. Well, we're coming up on our first break here. When we come back, we'll continue wrapping up with the fiscal cliff, and we'll get into our discussion on bear markets, a necessary evil.